Thursday, February 18th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at what gold and silver did the last time the yield curve was steepening as it is right now. Before I do that, I'd like to talk a little bit about inflation, especially seeing that the CRB index, crude oil, gold and silver is still a little bit, how can I say, under pressure, but they have risen. I mean, gold pre-told what we're seeing today by going to new highs last year, over 2,000. Yes, we're starting to see the years or decades of inflation come to the fore in terms of rising commodity prices, real things. The powers that be have been able to keep the price of real things suppressed in order to keep their fiat currencies looking good. I mean, can you imagine that after over 12 years of massive money printing and credit creation, that commodities are still below the level that they were back in 2008. I mean, that's what they've been able to do. But as you can see here by this chart now, they're losing control of it. That's the red line, even though I've drawn it purple. The red line in the sand is just around 205 in the CRB index. And then if you put the CRB index together with crude oil, you can see that they're both starting to break out. So as I say here, the Fed needs to exclude all commodities from their measures of prices, or the PC index. I think they already do that by looking at the core CPI or core PCE. So, and before I move on to the bond market, the yield curve and precious metals, I like to say one thing about inflation, and this is not me who said it. It was Felix Sommery, who was known as the Raven of Zurich. I recommend you look him up on Wikipedia. I'll put a link to his book in the description. It's very hard to find this book. It's very expensive as well. And what's surprising to me is that one of the books Jim Rickards wrote a few years ago, he talked about Felix Sommery. I think he's read the book, and I bought this book like over 15 years ago, so I've had it for a long time. And Jim Rickards didn't seem to learn from the Raven of Zurich what the definition of inflation really is. He said, Felix Sommery, that inflation is purely a monetary phenomenon, and that only government and the central bank can create inflation. Jim Rickards still seems to be in the paradigm that the PCE is inflation. But anyway, I don't want to have a go at people, but just to make my point here. So what did Felix Sommery say about inflation, aside from it being a monetary phenomenon and only governments and central banks can create it? Well, he said, and I quote him, "Inflation, on the other hand, can go on for years without its victims becoming conscious of the incredible way in which they have been swindled." So looking at that CRB chart, and we'll bring it up again. So I think what Felix Sommery was talking about people being swindled without knowing that there was inflation, the CRB really shows that, because for the last 12 years we've been told that there is no inflation, that the danger is deflation. And I think what commodities going up like this and fiat currencies going down versus them, because I don't think it's only the dollar that's going to go down, but all the fiat currencies, it's going to reveal to people that they have been swindled. And I think with that, we'll go on to the yield curve and what the yield curve is doing right now. So what is the yield curve? Well, in the bond market, in the Treasury market, which is the U.S. government bond market. The yield curve starts at 1 week, and then 1 month, 3 months, 1 year, 2 years, and so on. Those are the terms of the loans that the Treasury issues. They become bonds or notes or bills. And the yield curve basically plots the yields for different maturities. So let's say right now, I think the 2-year yield is around 0.11%. The 10 years at 1.3, the 30 years around 2%. So the yield curve has started to steepen. And usually it's a sign that the economy is picking up, but it could also be a sign that the central banks are keeping monetary policy too accommodative. So that's a sign of the yield curve. It could also mean a sign of crisis, I would say, because back in the sovereign debt crisis of 2011, 2012 in Europe, the countries that were in trouble, like Portugal, Italy, Greece, Ireland, and Spain, or the so-called pigs, their yield curves really went through the roof in terms of the difference between the short-term rate and the long-term rate. So when the short-term rates are the same as the long-term rates, the yield curve is flat. Sometimes the yield curve will go negative. That happens usually when things overheat and the central bank raises rates very quickly, the short-term rates, and then the long-term rates drop. That's an inverted yield curve. That's a sign that we're going to get a recession. But during the sovereign debt crisis, the ECB base rate was near zero. I don't remember exactly where, but and we saw yields going to double digits in those pig countries. So the yield curve steepened massively. So it can be, I think, a sign also of loss of control, of a debt crisis. So with that, let's look at the 2s, 10s. Usually the yield curve, people look at the difference between the 2-year and the 10-year as a benchmark for the yield curve shape. And as you can see here, this goes back to the early 90s. We're going to look more at the period from 2007-8 till now. But as you can see here, just before the recession in 2007-8, 9, the yield curve went negative there. So that's a sign of recession. Even here, late 2019 or mid 2019, the yield curve went slightly negative. And people were saying, wow, this is a sign that there's going to be a recession. I remember at the time a lot of people saying, oh, it doesn't always work. But it was very right that it worked again, because what have we had after mid to late 2019? We've had a Great Depression, really. So the yield curve works, these signals. But the most interesting thing, because there's been a lot of debate, of course, about yields going up, long-term yields, and how that's going to be bad for gold and silver. But I was trying to find the other day this chart for the yield curve. This has come from an article that I saw, and I recognize where it came from. It came from like a Bloomberg terminal. I used to use Bloomberg terminals when I was in the city, but I don't anymore because it's very expensive. I think at the time when I worked in the city, the firms I worked for, they paid for it as part of the cost. I think it was about $2,000 a month. So it's very expensive to have that. And I was trying to find that chart. And luckily yesterday I saw this article and I saw, wow, there it is. So I did a screenshot and I did a little bit of analysis. So if you look here, when the yield curve went negative, I think it was back in 2007, middle 2007. If you look at gold, it was still around or just below $600. And then the yield curve started steepening. And it steepened, made a double top, but it was almost at 300 by 20. Well, if you look here, middle of 2011, so it's steepened almost to 300, and you can see that's above 200 to 300. That usually is the top, or above 250 is usually a very steep yield curve, and from that level it turns around, as you can see. But you can see that what happened to gold. Well, it was around 600 or even below that in 2007, and it went up to 1,920 or 23, I don't remember exactly, in the middle of 2011. And what did the yield curve do? It steepened massively. As you can see, in the last 30 years, that's the steepest it's been. And that's when gold went through the roof there in 2011. So it was like a percentage move of over 200% for gold. And as you can see now, the yield curve went negative towards the end of middle end of 2019. Ever since then, the yield curve has been steepening. Of course, it could flatten again, but it looks like the trend is set here. I did give a phone call to one of my old colleagues that's still in the city. Well, he's at home, but still employed in the city. And he eats, sleeps, thinks, bonds. That's his life, bonds. And I told him about that one and said, oh no, don't worry, it's going to flatten again. Short-term rates are going to go negative. People are going to be buying treasuries. He doesn't seem to be concerned. And I said, what about commodities? They're going up. They're breaking out. And he said, well, this recovery is artificial. It's all stimulus. And I said, well, back in 2008, 9, 10, 11, the yield curve started steepening as well because of all the stimulus. He said, well, but that was real stimulus. I said, what's the difference stimulating in 08, 09, and 10, 11, and now? And he said, oh, because it's going to the public. And I said, well, so it went to Wall Street. It's a real stimulus. So I'm not sure. And then I contacted another fund manager who I know from the States. And I told him about the story and the yield curve. I sent him the charts. And he said, oh, your friend, is he a president of the Federal Reserve? Is he a Federal Reserve president? So we will have to see, but it looks like that trend is really set here for steepening. And I don't think the Federal Reserve wants that, nor does Uncle Sam, because the difference now to 2008 is the debt. So we're going to look at the US debt clock. I mean, right now, the national debt, the public debt that Uncle Sam owes is almost 28 trillion, and the debt to GDP is 131% almost. So let's go back and check 2008. The debt was 20 trillion less almost. It was just under 10 trillion. And the debt to GDP was 71%. So if you get the longer term rates going up like this, we could have a debt crisis. Maybe the sovereign debt crisis of the periphery in Europe back in 2011, 2012 was a warm up for the real granddaddy of debt crises. So could we even go above the 250, 300 basis points of a steep yield curve? It's possible. It's possible. And that would really be a sign of a crisis. Is this going to happen overnight? No, but it could accelerate. Yields could go up very quickly. So we need to keep an eye on that. So yeah, that's what gold did back then. And as you can see here, gold has been going up ever since the yield curve started steepening. And the same thing for silver. I didn't forget silver, of course. Here you go. Same thing. If you go back to 2007, silver was trading between $10 and $15. Yes, it did dip during the crisis of '08, but look what the price did. It went from below 10 all the way up to 50, and the curve steepened, of course, from around -20 to almost 300. And it looks like right now the trend is for a steeper yield curve. And what that will do as well is that will encourage lending institutions to lend, because they'll be able to borrow very cheaply short term, because the Fed has said that they're going to keep rates near zero for the next 3 to 4 years. I mean, last year Jay Powell said we're not even thinking about raising rates. So yeah, lending institutions will borrow very cheaply and lend a lot higher longer term. So that's going to create even more inflation. The money supply will go up even more. It's a perfect storm, I think, of inflation and rising prices. So with that, let's quickly look at where the markets are this morning. I'm a little later today. It's 10 to 9 a.m. London. We've got spot gold at $17.86. It's up $10. The high has been $17.87, the low $17.74.50. Yesterday it was pretty interesting because they couldn't keep silver down, so they smashed gold in order to keep silver from rising that much further. Today they're letting gold go back up, and they're trying to keep silver down because silver is down 5 at 27.30. Range has been 27.09 to 27.54. The Dow future is down 18 points. S&P is down 6. NASDAQ 100 future is down 57. The pound is up 1/3% at 139.10. The euro is up 0.2% at 120.64. The dollar is down slightly versus the yen at 105.74, and the dollar is up 1/3% versus the yuan at 645.50. High grade copper 392.66. Wow. I just realized copper is going through the roof here as well. Look at the monthly chart of copper. I mean, copper is a real bellwether indicator for the economy. It's a huge sign that things are heating up. So that's very interesting. Copper up, I think here, let's see, up almost 3%, 2 2/3%. Crude as well, up 2/3%, almost up. Well, we've been above 62 today, overnight. It's now 61.50. And you saw the chart there. Crude oil, a long-term chart, WTI crude is breaking out of this massive trend line, just like the CRB. So I think it's all coming into place. I think it's going to get very interesting. I think the Fed is losing control of things, and the Treasury as well. No matter what happens, I think, we're in for a wild ride. They might let yields rise. The only way to keep it down is to announce an increase in QE, and that would put a rocket up, I think, gold and silver prices even more than there should be a rocket right now, I would say. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. I wish you all a great day. Take care. Bye.